Hi, I am Sheila Darby, a managing director here at BizWorth. Thank you for joining me for this video on how to value a business. This is a video covering the asset approach, and this follows the introductory video that introduced three approaches to you. So, the three generally accepted valuation approaches, as a reminder, are the asset approach, the income approach, and the market approach. This video is going to focus on the asset approach. So, what is the asset approach? The asset approach provides a way to determine a value for your business based on the value of the assets net of the liabilities. There are several instances where you may really want to use an asset approach. But with that being said, a certified valuation professional is going to consider the asset approach for every valuation engagement. And depending on the facts of the valuation engagement, we may choose to use the asset approach or not to use the asset approach. But there are some times when the asset approach can be very insightful. And those are for holding companies or investment companies, also for businesses that generate losses, for companies that may be considering liquidating, and also for high valued real estate companies. Those are just some of several good examples of when the asset approach may be particularly insightful. So, to use the asset approach, there are methods that you would employ to value a company based on the asset approach. There's two very common methods. The first is the book value method, which we will cover. We will cover the definition and an example in this video. And then there's also the adjusted net assets method. And we're also going to cover the definition and an example on how to use this method as well. When we get started here, the book value method, this is a very well-known and can be popular method, but a very well-known method for valuing a business. And this is based on the assets and the liabilities that are reported according to various accounting conventions. And this method may or may not reflect the current value of a business. So again, these are the assets and liabilities reported at historic value based on accounting conventions. For using this example, I want to first introduce a company to you. There was a gentleman that was probably in his late 60s, early 70s, and he reached out to BizWorth, and I had a meeting with him. A very bright individual that had a very successful first business, sold it, got bored, and wanted to start a second business. And in this business, he created a medical records business. And this medical records business, I believe, had revenues fluctuating between probably 350 and 500,000 per year over the 20-year lifespan. So it was a nice business. It wasn't a huge business, but it was a very good business that consistently generated profit for the owner. And in talking with him, he spoke about the revenues and how predictable they were, and that he really just was ready to finally retire. And again, this gentleman was in his late 60s, early 70s, had already a profitable business that he had sold about 20 years prior. And now he had created this medical records business and he was ready to sell it. And he was tired. He wanted to get rid of it. And he felt as if with the revenues between 350 and 500,000 that had fluctuated over the years for contracts rolling off and new contracts coming on, he just wanted to get rid of the business and turn a profit. And he was thinking maybe somewhere in line of, hopefully I can sell my business between 150 and 350,000, maybe 500,000. But he didn't quite know what the value ought to be. And so in taking that call, we walk business owners through the three general approaches and how we'll look at the business. And one of the approaches that we discuss with the business owners is the asset approach. So we had a quick conversation around the assets of his business, and he let it be known that his medical records business that was serving one small regional geographic area was inside of a very large building, and the tax value, just the tax value on this building alone, was already something greater than the historic value, the book value of his land and of his building. So this is a rough idea of what his balance sheet looked like, and we've changed lots of numbers here. But I thought it'd be fun to try to see a somewhat real world case example. So here, this company had cash and they had accounts receivable. They also had some inventory. But you can see here that this company had land and buildings, and there was also a large amount of accumulated depreciation on the books. But in total, the total fixed assets of this business was almost $300,000. There was also a small amount of current liabilities, and you can see where the total equity of this business was. So, in valuing his business based on the historic book value method, you can see that the historic assets were approximately 447,000, historic liabilities were approximately 385,000, and the value of this business came out to be approximately $63,000. So $63,000 based on historic book value for a company that generated revenue of 350 to 500,000 over the 20 each year for each of the 20 years of operational history. And so quickly knowing that this probably was not a good representation of his business, and oftentimes the asset approach really may not be the best approach, particularly the book value method. So the next step for a valuation professional is to look at the adjusted net assets method. And some people are not familiar with the adjusted net assets adjusted net assets method. So what is it? This is the book value of the assets when they are adjusted to fair market value. And this could be measured as a replacement cost, a liquidation value. Also, if there is land and buildings, you could have a real estate appraisal that would inform what the fair market value is. And then this fair market value of the assets are then reduced by the fair market value of all the recorded and unrecorded liabilities. So for this company, what does that mean? So for this medical records company, there was an adjustment made for the land and the depreciable buildings. And here we just showed this complete adjustment in one entry here, but this would for simplicity, but this should be broken up according to the land and the buildings. And when you look at the value adjusted for this, you'll see that the adjusted value is $884,000 as compared to the $63,000. And for this particular company that was sitting on very valuable land and inside of a considered to be a valuable building, this was probably going to be the best valuation approach for this business owner. And that cannot be said for any and all businesses. But for this particular business that was using maybe 1/10 of the building that they were located in, and for being on a very valuable piece of property and inside of a building, the asset approach was likely going to be the best approach. And it was not going to be the book value that was going to place an indication of value of $63,000, but it was going to be this adjusted net assets method that was going to prove to be the most insightful and provide the most current value for this particular business. So you can see if someone's just relying on the book value, how much money would have been left on the table. And in most instances, the income approach and the market approach will likely yield a higher value than the asset approach. Certainly not for all businesses, holding companies, high valued real estate companies, companies close to liquidation value, companies that are generating losses, for example. But there are those cases that there are profitable businesses that the asset approach will still yield probably the most insightful current value for the particular business. So with that example, I hope the asset approach makes more sense. I hope the overview of the book value method and the adjusted net assets method is helpful and it makes more sense. If you have any questions, don't ever hesitate to reach out to us here at BizWorth. And if you found this video to be helpful, please do share it on Facebook or LinkedIn or our YouTube channel. That helps us a great deal, and we certainly appreciate it. So thank you for watching this video, and I hope you watch the other videos on the income approach and the market approach. Thanks so much.